Good morning, everybody, and welcome to Knight Frank's Kenya Market Update First Half 2021 webinar. My name is Ben Woodhams. I'm the Managing Director of Knight Frank Kenya. Thank you very much for joining us today as we share insights on Kenya's real estate market performance for the first half of 2021. Knight Frank's Market Update is a unique report that's produced twice a year by our research team. The report reviews retail, office, residential, hotel, tourism, industrial, institutional property segments against the country's economic performance over the period. In other words, the first half of this year. This year, Knight Frank celebrates 125 years as a brand, and it is a brand that has grown to become a trusted advisor and global leader in real estate consultancy. We have more than 20,000 people operating from 488 offices across 57 territories. We also have a network of offices in 9 countries across Africa, and that enables us to offer a broad spectrum of real estate services right across the continent. In Kenya, we advise clients ranging from individual owners and buyers to major developers, investors, and corporate organizations in various services ranging from commercial, residential agency, occupier services, retail agency, property and facilities management, valuation, advisory, research, and consultancy. So our program today will begin with a virtual presentation of the market update by Charles Macharia, who's Head of Research at Knight Frank Kenya. Thereafter, there'll be a panel discussion with our panel of Knight Frank experts who you see before you now. I will introduce them to you after the presentation, and then we will go on and answer questions that are submitted during registration and also during this session, which you can do on the Q&A panel below you. If you go to the top of the screen, you will see a button that says View Options. If you choose Side by Side, then you'll find during the presentation that Charles is doing, we, as our mugshots won't be obscuring his presentation. We'll be pushed over to one side. That's up to you, obviously. If you'd like to do that, it'll be slightly smaller, but none of it will be obscured. Okay, thank you very much. And Charles, over to you, please.
Thank you, Ben. Good morning, ladies and gentlemen. My name is Charles Macharia. I work in the research department of Knight Frank Kenya, and it is my pleasure to take you through the key highlights of the 22nd edition of the Knight Frank Kenya Real Estate Market Update. This is a biannual publication that covers the performance of various real estate sectors in Kenya. The key sections of the reports and what forms the agenda of today's webinar include the following. We'll cover the macroeconomy that has a direct correlation on the performance of the real estate sector. We'll look at Google's mobility index that basically just shows where people are spending most of the time in relation to a baseline. In our case, the baseline is immediately pre-COVID. We'll also look at various, with regard to property market activity, we'll look at property transfer activity, and we'll also look at the performance of various real estate asset classes. This include the office market, the retail market, the residential, industrial, hospitality, and we'll also look at land price trends before just giving a brief outlook of the various real estate classes. Getting straight into it, with regard to the macroeconomy, as expected, the economy is estimated to have contracted by 0.3% in 2020. This is primarily as a result of the pandemic. This adverse effect has trickled down to the real estate most asset classes. However, it should be noted that this is still better than the overall performance of sub-Saharan Africa. For 2021, it is expected to expand to 5.6%, then expand to 4.7% in 2022. Key economic risks include currency depreciation, increased lending rates, inflation, unemployment, increasing debt levels, and for 2022 specifically, the upcoming elections. So we, based on these factors, you're looking at least a recovery period of at least 2 years. The challenges that have come up as a result of the new norm have continued, such as government restrictions, social distancing, and basically adopted to the new norm in terms of working from anywhere, homeschooling, PPEs, wearing of PPEs, etc. Despite these headwinds, Kenya remains a regional hub for most organizations. And because of the strong demographic characteristics, such as a youthful, educated population, means that some asset classes will experience more resilience than others. Moving on to Google's mobility index. This is just an index which compares the level of activity compared to a previously set pre-COVID baseline. From the graph, it indicates that workplace, retail, and transit activities across the country initially fell as a result of various restrictions, but is slowly recovering and even back towards the baseline as the economy is opening up and easing of government restrictions. This is in addition to the rollout of the various vaccines. For the residential sector, this still remains above baseline as the work from anywhere mode of working is being adopted by various organizations. Restrictions were eased towards the end of the third quarter of 2020, and mobility to various places continues to go back to pre-COVID levels. Looking into the future, there still remains some uncertainty as Kenya grapples with the pandemic and the management and rollout of the various vaccines. Getting into the real estate market, from the graph, the number of transfers had decreased significantly in 2020, but notably it increased quite a bit in the first half of 2021. This was a result of pent-up demand as buyers had to put on hold their investment activities in 2020. But because of the increased certainty brought about by the reopening of the economy and the rollout of the vaccines, buyers and tenants have taken advantage of the market as various vendors and landlords have reduced their prices quite considerably. Getting into the office market, supply remains steady in 2021, and we expect the same in 2022. However, we note there's a substantial decline in office space supply in 2023. This is backed up by the overall decline in the value of building approvals in the first half of 2021 compared to a similar period in 2020. Oversupply from 2016 to 2017 still remains a challenge, as well as the new norm of social distancing and changing working habits, such as working from home and indeed working from anywhere. With regard to office occupancies, they rose marginally in 2021 to 73% from 71% in 2020. So what has been the overall effect on the rental levels? With regard to prime rents decreased by 13% in the 2020 and are yet to recover in 2021, obviously because of the challenges that were brought about by the pandemic. Interestingly, take-up absorption for 2021 to date has already overtaken total absorption for 2020. This is just by the fact that in 2020, various businesses put on hold their expansion plans. So there was very little activity in 2020. The increased take-up of 64% in 2021 implies that the office is not dead. It's just a shift in working habits, such as working from anywhere, that are becoming the new normal. And this play into the serviced office sector operations. Investor and tenant focus remains on the elements of safety and sustainability. Looking into the retail market, similar to the office market, the pandemic and the historical oversupply remains a challenge. Developers have slowed down their investments and have shifted their focus to more neighborhood centers rather than regional malls. Government restrictions and adverse economic conditions has also meant that consumers have less disposable income, implying less trade for retailers. This has led to a downward pressure on rentals and occupancies, resulting in more flexibility from landlords. There is also competition from online shopping. Statistics show that e-commerce in Africa is estimated to have increased by 42% to $20 billion in 2020. Similar to the office market, supply will decrease drastically in 2023. And despite these headwinds, again, there are still pockets of opportunity as some retailers continue to expand their footprint. Looking into the very vast residential sector, affordable housing remained and will continue to remain a key trend into the future, with a housing deficit of 2 million units, with a key player being the central government through its Agenda 4 program. For the first time in the longest time, there was a decline in the number of mortgage accounts in 2020, as there was less lending from financial institutions. The average mortgage rate is currently at 10.9%, the lowest it's ever been, implying improved lending conditions. With regard to the prime residential market, there was a drop in residential sales and rental prices, though this trend was already occurring pre-COVID, but the pandemic just accelerated this. With regard to investment in other sectors, there was increased investment in purpose-built student accommodation. This a trend we expect to continue because of the youthful, educated population. The sector remains highly fragmented and comprises mostly of substandard housing. Hence, developers are seeing the opportunity to build an above-market affordable product through economies of scale. Looking at the industrial markets, rents range in the region of go from as low as 20 shillings per square foot per month to as high as 80 shillings per square foot per month. This is primarily based on location and product specifications. Average occupancy levels are between 70 to 80%. We have witnessed an increase in rentals over time that is primarily attributable to development of more quality stock. And by more quality stock here, we are talking about A-grade warehousing. Emerging trends that continue to be of interest to investors include A-grade warehousing, infrastructure, data centers, cold storage, and self-storage because of the flexibility afforded by self-storage. We expect that most upcoming stock will be outside Nairobi. This is because of the high development costs within Nairobi, more specifically the high land costs and improved infrastructure in and around the city. Increased investment continues along major transportation corridors, and we estimate there's approximately 4 million square feet of warehouse space coming that is in the pipeline to the end of 2023. Going into the hospitality market, this is definitely the hardest hit sector. It is estimated to have contracted by 70% in 2020, as earnings declined from 163 billion in 2019 to 45 billion in 2020. Obviously, decline in tourist arrivals has a ripple effect on the performance of this sector, as 2021 levels are still approximately 30% of 2019 levels. Reliance remains on local tourism, as occupancy levels, as can be seen, are estimated to be at 23% currently. Consequently, we will continue to witness a lot of distress in the sector in the short to medium term until a new normal is established. Looking at the prime development site price trend, from the table, we note that there has been a decline of over 20% of asking rents from pre-COVID levels. This fall in prices, together with the falling rentals, implies that the market is still by and large a tenants and buyers market. So you see in some areas, the price drop is much greater. For example, in Upper Hill, we've seen price drops of even 36%. A brief outlook on the sector, on various sectors. For grade A offices, we expect moderate demand in the immediate and longer term. For serviced offices, of course, because of the social distancing, we expect a moderate demand in the immediate term, but because of the flexibility afforded with serviced offices, we expect a positive outlook in the longer term. For regional shopping centers, the immediate demand remains negative, while the longer term remains moderate. For neighborhood malls, because of the convenience afforded by such retail centers, we expect the immediate demand to be moderate, while the longer term demand to be positive. Prime residential real estate, we expect both the immediate and longer term demand to be moderate. These are, of course, because of the headwinds that were previously there pre-pandemic, and because of the high capital prices and the adverse economic conditions. For affordable housing, the immediate demand and longer term demand remains positive because of the demographic characteristics and the 2 million housing supply deficit. For the logistics sector, again, the immediate demand and long-term demand remains positive, though this is for strategically located assets. For the hospitality sector, we expect negative demand in the short term and a moderate demand in the long term as it adopts to the new norm. For student housing, data centers, agriculture, and healthcare, we expect both the immediate demand and the long-term demand to be positive, obviously based on various demographic characteristics and because of various change in habits. For more information on the regional and global real estate trends, please feel free to get in touch with us or check out our other sister publications that cover the entire markets. Thank you, Ben. Back to you.
Great. Thank you very much, Charles. That was fantastic. Really insightful. And of course, the copy of the first half market report is available online, and we'll be sharing information with you as to how that can be downloaded, or hard copies can be obtained from our office as well. So now it's time for our panel of experts from Knight Frank to answer some questions relating to today's theme. So obviously you've heard from Charles Macharia, Head of Research at Knight Frank Kenya. So joining us is Anthony Havelock, who's Head of Occupier Services and Commercial Agency, Stephen McCow is Head of Valuations and Advisory, Clearfast Bohr, the Senior Property Manager, Tarquin Gross, Head of Residential Agency, Ashmi Shah, Retail Portfolio Manager. So welcome everybody here to answer questions from the audience, and I'll kick off straight away with one for you, please, Anthony. With the much publicized oversupply of office space across the Nairobi market and the competition for occupiers fiercer than ever, what trends have you seen over the first half of 2021, and are there any signs of improved take-up straight demand? So that question is sort of implying the need for good news from your audience.
Thanks for that, Ben, and morning, everybody. I'm going to start. Cautiously positive, I think, is probably our take at the moment. The live agency feedback at the moment is really encouraging. If I look at what the team's been up to over the course of the year so far, Charles has already reported a 64% take up in space, and that's we're really seeing those trends. If I look at what's been going on, there's been 6 deals that have happened in the last 3 months or so that total over 250,000 square feet. Major deal up in Upper Hill, of around about 100,000 square feet. Big deal out at Garden City for 60,000 square feet. Major deal in the serviced office sector happened on Riverside Drive, around about 50,000 square feet. Another one in the financial institution, financial services sector for 30,000 feet. So, you know, I can pick 250,000 square feet of take up just out of 5 deals.
These are big deals. These are big
yeah.
deals. We weren't really seeing deals this big in the last couple of years, were we really?
No, it's encouraging. It's sort of back to what we were seeing back in 2015, which is kind of when the market was peaking here. And the level of inquiries that the team are getting is significant. You know, I think the team did a check yesterday on the number of live requirements that we're talking to at the minute, and it's up at around about 500,000 square feet of live requirements that are out there in the market at the minute. So, yeah, we're cautiously optimistic that the stats are there, that there is some take up, and what's clearly evident is the multinational is back. They are both new entrants and existing guys expanding as well. So yeah, key sectors, financial services, serviced offices, and the NGO market is really starting to move. So yeah, positive.
And addressing that issue of oversupply specifically, obviously, you know, the lead time from a developer having a thought to having a building ready for tenants can be anywhere between 18 months to 3 years. Do you foresee that this demand that we're seeing now will go some way to absorbing the oversupply that's currently in the market?
Yeah, I do, 100%. Yeah, rental levels are still relatively stagnant. I think actually the decline in rents has now ceased. So I think we've got some stability there. I think encouragingly, I think for the first time in the last, I don't know, probably 3-4 years, we've had a couple of squabbles amongst a couple of occupiers over the odd floor, which basically demonstrates that there is a bit starting to become a bit of a fight for some of the best space that's out there. You know, if you take UAP and you take Britam Tower and you take 1 or 2 other buildings out of the equation in Upper Hill, that takes quite a lot of that big oversupply out of the equation there. And so, yeah, I'm encouraged. So, you know, Charles's stat about, you know, 2023 and the lack of pipeline coming on board is going to become pressing. And so, yeah, I'm going to be bullish and say, you know, I give it 18 months and we're going to start to see positive signs of rental increase and growth back in the market, and some squabbles for space starting to happen, especially best in class.
Fantastic. Thank you very much. Everybody, you heard it here first. The economy is about to recover. Okay, so the next question is for you, Stephen, as in your capacity as head of valuations and advisory. The office market is experiencing an oversupply prior to the outbreak of the COVID-19 pandemic. With most people now embracing a blend between conventional offices and working from home, how would you say this has affected values of development land within the main office locations in Nairobi?
Thank you, Ben, for that question. As a follow-up to what Anton has said, values are responding to the trends we are seeing in the market. And given the oversupply that we saw prior COVID and the hybrid environment within which people are working, markets are responding. And as a result, we are seeing a value reduction to respond to that sort of quote-unquote reduced demand and the oversupply prior COVID. However, this is not unique for measures. It varies across sectors and asset classes. And like, you know, we have seen in our stats, the upmarket, Upper Hill and Westlands office locations have seen the greatest cut in terms of land values for development land, that is in office space. Upmarket residential, again, Westlands, Ridgeways, Karen, seeing a significant cut in development land. And that extends to a lower margin to the upmarket, to the upper middle class, as far as residential large relation. Lavington having a cut in land values, though not as big as we've seen in Upper and in Westlands, and that trend continues all the way. And we're seeing in districts where it is flat, it's certainly recovering the locations that are preferred by the lower middle, largely flat as the upmarket. So it's scenarios, but that's how it plays out. You know.
Okay, great. Thank you, Stephen. That's excellent. Right, next question. This is for you, Ashmi. There are many convenience retail centres popping up everywhere. How do you foresee these affecting the future of the bigger, more established malls in Nairobi?
Thank you, Ben, and good morning, everyone. Indeed, you are right. There are many convenience retails popping up in various strategic locations in Nairobi. And obviously, these have become a choice for shoppers, especially when the pandemic hit Kenya. But what we've seen is that, as much as the footfall numbers fell during this period, the numbers have gone back to sort of 85 to 100%, in the last 6 to 8 months. And that basically means that the shoppers have gone back to doing their shopping in the bigger malls. In addition, obviously, there are several malls that opened up their entertainment facilities during the COVID period. This includes the kids' play area, the cinemas, the bowling alleys, and basically this does reiterate that going to shopping center remains a form of entertainment in this part of the world, and therefore going forward, the future of the bigger malls still remains intact.
Yeah. Okay. Thank you. So another positive message. I mean, we don't want to sugarcoat the situation too much, though, Ashmi, do we? I mean, obviously, there is still an ongoing impact from the pandemic on right across the retail spectrum, I would imagine. Yes, there is. Okay, fine. Right, next question, and this is to Tarquin. It's currently believed to be a buyer's and a tenant's market, as opposed to a seller's and a landlord's market. How long do you anticipate this will last for, and what do you think the future residential market in Kenya will look like?
Thank you, Ben. Good morning, everyone. Yeah, I think the buy and tenants market is probably a reflection of COVID, and just 2020 as a whole was very slow. But I think it's, in many ways, it's actually been to our benefit, because it's meant that everyone's taken a deep breath and allowed sellers and landlords to just reassess what they're offering, what the market is entailing, and what buyers and tenants are effectively looking at. And I think what's happened as we come into 2021 is we're seeing a much greater number of transactions, sellers and landlords reassessing their prices, looking at what their competition is taking, but also what they can achieve. Coming into Q2, some of our, if I talk specifically on our portfolio stock, especially talking about landlords, we're seeing a much greater occupancy rate. This is reflective of, the foreign nationals coming back into Kenya.
So we're starting to see that happen, are we? The expatriates returning back into the country.
Yeah. So a lot of the expats are moving back from a rental point of view, which is meaning that sort of. But also what this is entwined with is that the landlords had reduced their prices or sort of reassessed what they would be willing to accept. So as the expats are coming back, back, and the prices have been slightly adjusted, we're seeing a huge increase in the occupancy levels, especially in our sort of prime places. And I think that will be a catalyst as it goes down. Usually in these instances, one class is sort of getting better occupancy, the rest will follow. So I see in terms of the tenants market, I think it's there right now. Do I foresee that it will still be there come the end of 21, 22? Probably, but not so much in 2022. I think as we sort of go into 2022, I would say that, especially on the rental side, I think landlords will probably, on the prime places, be a bit more bullish again.
Yeah, and so these price corrections that you're talking about, landlords adjusting their prices, I mean, are they slashing them by 50% or adjusting them by 10%? What's your experience there?
Typically, on the sales side, we're seeing offers being accepted between 10 and 15% off the asking price. On the rental side, probably not as much. I think typically landlords have actually been slightly more, maybe adjusted slightly, but actually more interested in just receiving the offers. So yes, our offers are probably 5 to 10% less than the asking price. And
we're not talking about a crash in the market. We're talking about a minor price correction, which presumably will go the other way once demand exceeds supply as well, and we start to see growth back again.
Yeah, absolutely, absolutely. But I think, you know, it's definitely not a crash, but I think that the market needed it. I think, you know, prices in Kenya have sort of gone up exponentially for a long time, and no one sort of corrected or had a reason to stop and think. And I think what the market's doing now is actually it's slight adjusting, and it's probably coming to what the actual going rate should be. So some could look at COVID and say, oh, that's affected it. And yes, it has to a certain degree, but actually in the grand scheme of things, what it's done is it's meant that everyone's taken a deep breath and just looked at it. And actually we're probably now sitting at a much more even and even keel.
So in summary, then really it's had a bigger impact on the number of transactions rather than the price point itself, really.
Exactly.
Yeah. Okay, great. Thank you very much, Tarquin. Right, this question for Clearfas, Senior Property Manager. How has the pandemic changed commercial and residential property management? And consequently, why is there now, today, an even bigger, better need for outsourced professional property management services than there's ever been before? Why is it more important today to have professional management?
All right, thank you, Ben, and good morning all. After the onset of the pandemic in 2020, we moved into uncharted waters in terms of property management. So we had to move very swiftly to comply with the best practice and align properties with the requirements. I mean about social distancing, making sure that we had hand washing stations or hand sanitizing stations, as well as making sure that we have signage in the properties and screening of visitors and tenants as they came in. We also encountered now with the lockdowns and the restrictions that followed the working from home, reduced occupancies in the buildings, though this does not strictly apply to residential. For residential, it remained fairly the same because people still needed to stay in their residential houses. So the pressure was mostly on the office and probably retail. In line with that, we had to move towards working to reduce the costs, of course, to benefit the tenants and also our clients. We also had, because of the pressures that came with the restrictions and the lockdowns, of course, business challenges for our tenants. So most were not able to honor their obligations, and we had to handle situations of giving them some temporary relief, including doing some deferrals or waivers, as well as reductions of rent. We had to renegotiate in a few cases the rents for several of our tenants. And in extreme cases where a business was not going to be sustainable anymore, we then had to see about separation, because when one is not able to meet the obligations, then the best you can do is probably work out a surrender. As well, with the pandemic and handling any arising issues of the properties, we had to be on standby to make sure that we handled any cases right away and disinfected the properties, and of course informing everyone and making sure that they were aware. We had thought this would be a temporary situation, say for 1 year, but it appears that it's there to stay with us, so we'll keep on handling it.
Okay, great. Thank you for that. So I mean, really, professional management has just been more important because we've been in such a state of turmoil. It's been all hands on deck, as it were. And so having a professional team of people to do that has given us a better chance of coping with those problems than otherwise might have been possible, really.
Yeah, that's very correct, Ben. It's good to have a professional to assist you in that process, because I mean, at the same time, landlords were going through the pressure of, they were staring at the reality of default, because the inflows were not coming in as expected. So then we would assist our clients in giving perspective and also shielding them from the pressure that's coming from the tenants.
Absolutely.
Of course, with our expertise and best practice, we're able to handle any arising issues without having to have the escalations of getting into legal issues.
Yeah, thanks, Clearfas. A bit of shameless self-promotion there. Well done. Great. Okay, moving on to questions that have been submitted by the panelists, by the audience. Question here for you, Anthony. Has office occupancy levels been affected by working from home trend? In other words, I suppose we've heard a lot about people working from home. Is the office market dead? What's been the effect in the short term? And what, in your opinion, is the sort of medium to long term effect of more people working from home than being in the office?
Thanks, Ben. Common question, which has obviously been kicked around the globe for the last year, 18 months. Bottom line, the office is definitely not dead. If not, I'm seeing some really encouraging signs. I mean, effectively, we're all changing the way we work and the way we live, and that's obviously been forced upon us. There's a lot of what we're doing now, fatigue, from what I can pick up on there. I think people are bored of online, people are bored of virtual, people are bored of doing Zoom meetings. A lot of businesses have lost their culture and lost their interaction and the rest of it. And so I think encouragingly, we are starting to see a meaningful return. I think if you talk to Clearfax in our management department across our portfolio, occupancy levels are back at around 75%. So, you know, people are now back in the workplace and have adapted to how they now use their space. I think the key thing is, and the message for developers and landlords is, you've got to adapt your office space to what the modern occupier wants. Clearly, everybody's staff is hugely important to them, the safety of them, but more and more importantly, everybody's got to be proud of their brand when they get to their office. They want to have a statement office. They also want to be able to entertain and look after their clients there. But, you know, social amenities, breakout areas are hugely important, and the occupier is demanding that together with sustainability as well. So all of our sort of landlords and developers in the market now need to readapt how they design and how they present office space to the market going forward. So
you think tenants' requirements are going to get more important and more demanding, as it were? ESG, sustainability, disabled access, all of that kind of thing. Those are the kind of things that our developers, our landlords need to be thinking about in their new buildings.
Hugely important. You look at any RFP from any global occupier today, you're going to score additional points if you've got ESG criteria there. If you've got amenities within the building or nearby is very important. We've had 3 big RFPs very recently, which disabled access is huge. You know, the days of having one disabled washroom on the ground floor are well gone. You know, we can't get away with that. Kenyan standards basically don't apply. We've got to move towards international standards of office design. And if you don't do that, you won't attract the best occupiers, full stop.
Okay, thank you. So segueing back to residential, pretty much the same topic, really. Another question from the audience. What are some of the emerging trends in the residential housing market in this pandemic? So, you know, how's the working from home dynamic affected what people are looking for in homes? Are they moving away from apartments into houses? What are the trends that we're seeing as a result of the pandemic and also coming out of it?
Thanks, Ben. So in terms of obviously people not going to the office, working from home, the key outtake, or what we've seen that people are looking for, greater privacy. So in apartments or homes, they want their own space, a family unit. So gardens, you know, that outdoor space has become key as well. You know, if they are working from home, they want somewhere to get away from their office, somewhere outside, fresh air. So, you know, the outdoor spaces have become key. Obviously, home office is a key one, but that being said, you know, people are being quite open to how that home office could work. And then, you know, in terms of sort of those sort of key differentials is what is meant that people are wanting, you know, looking at these things, but also investing wise, looking at them. So our developers are now focusing on them with high-end residential units. You know, the amenities is key. So if you're a developer, as Anthony said about sort of the commercial tenants wanting more, tenants want more. They want these amenities. So, you know, what a developer offers to their buyers is key. And then, you know, when people are looking for their own home, it's sort of taking all these into consideration.
I mean, as you said, the home office is the obvious one, but what other? I mean, it just more distance from your neighbours, you know, moving from apartments to townhouses, you know, those kinds of things. I mean, what other trends are you seeing?
Well, I think, yeah, like the home office would seem to be the key one. But, you know, for example, we've seen a real massive uptake in our inquiries for coastal and upcountry stock. So in fact, that's the other thing that's been happening, is that people are sort of going, well, maybe I don't need to be in the center of Nairobi anymore. Maybe I can work further afield. We're seeing a lot, you know, the transport links between Mombasa, Nairobi, around the country, the infrastructure that's going on in Nairobi anyway, you know, it's going to mean that everyone's sort of perceptions are changing. So I think, you know, it's that sort of, also like access to healthcare is obviously a big one that's also come out of this COVID situation.
Yeah.
You know, so it's sort of a sort of mix and a blend of everything, but definitely your home is sort of your palace, as it were, and being able to live at home, work at home, be comfortable at home, and not having to go out to get other things, as it were.
Yeah. Okay, great. Thank you. So this is one from the Q&A chat that's come in. Thank you, Charles, for a good presentation. This isn't from Knight Frank, I promise. And to Knight Frank for this study. I'm curious on what supports your outlook on student housing, given that unlike primary and secondary schools, tertiary institutions are really gung-ho about the shift to online studies, save for physical courses like medicine and engineering. How would you integrate the rhetoric coming from tertiary institutions about their shift online to your outlook on student housing? So in other words, if everybody's studying from home, why is there an interest in building accommodation for students? I think that's the gist of that question.
Thank you for that question. Why the gist on student housing? I think this gist from student housing not only comes from learning institutions, but you find that majority of the Kenyan population, the average age of the Kenyan population is 20 years old. So you find that most of the demand is in young professionals or accommodation that caters to that specific type of demographic. That said, you as highlighted in the presentation, that segment is not quite populated in terms of quality stock. You find it that it's highly fragmented, and there's just not enough decent stock at an affordable rate. So you find that big industry players, investors such as Aecon Holdings, have seen the gap in the market and are capitalizing on it quite considerably.
Yeah, and I think also the other thing must be that whilst people are, you know, studying online at the moment, there is a general trend that you know, they are expected to go back to tutorials and to seminars and to lecture halls at some stage in the future, and so there will be that return to normality. Would you agree?
Yeah, I absolutely agree. That coupled with the rollout of the various vaccines means that, yes, we will go back to the previous norm. Hopefully there will be no other variants coming along. So physical and social distancing, hopefully if the vaccines work, will become a thing of the past. Already you're seeing in the developed countries, things are slowly going back to normal in terms of activity.
Okay, so it's only a matter of time that will happen here too. Thank you, Charles. Okay, so Ashmi, one for you here from one of the questions submitted in advance of the seminar. What are the post-COVID trends in retail? Interested in knowing more about the current state of extensions of leases, whether we're still giving concessions and so on and so forth. Where are we right now in the sort of current status of the relationship between landlords and tenants in shopping malls?
Thank you, Ben. So as we're all aware that retail was probably the second hardest hit after hospitality. But as I mentioned earlier on, the footfall and the vehicular traffic has pretty much gone back to normal now. And we're seeing that 85 to 100% of the pre-COVID numbers. F&B was one of the hardest hit within the shopping centers because of the curfew hours. However, even these tenants are now trading better. They've had to sort of reinvent themselves and, you know, have deals in place. They've tried to change their online marketing just to help them trade better. We've also seen that some of the local brands are continuing to expand and take up spaces in all our existing retail centers. And another trend that we're also seeing is that a lot of the tenants are now looking for other spaces to reduce their cost. Also, in terms of concessions, most landlords have stopped the concessions. They were giving concessions up until probably March, April last year, some up to the end of June. But from this quarter, most of the landlords have stopped their concessions.
Sorry, I put myself on mute. And that's as a result of the increase in footfall in the malls and the general feeling that trading is returning to some form of normality.
Correct.
Okay, so I've got 3 more questions to get through on the Q&A that have come through here. First one, rental rates in the commercial segment have been stagnant for the past 5 years. When can we expect the rates to resume their upward trend? So I think Anthony touched on this in a previous question we'd asked. So basically, when we get to the point where demand starts to outstrip supply and tenants start fighting over space rather than landlords start fighting over tenants, which is the current situation, at that point we'll start to see the rents increase. And I think, Anthony, you had said you'd estimated that might start to happen within the next 18 months or so. Is that right?
Yeah, I think just picking up on that, I mean, Charles said it. I think we've seen a 20% decline in prime commercial rents, both in office and also in the retail sector as well, if I'm honest. So they haven't been stable. We have seen a recorrection, and they have come off quite significantly from where they were back in 2015-16. So, I think we've seen the decline. They've been stable probably now for the last 6 months or so, or maybe certainly the last 3 months. And I do foresee a situation probably, maybe towards the back end of this year, depends what the politicians do on the elections next year, but I do see some rental growth definitely around the corner, because there is you've heard it here now, I think we're going to see a shortage of what I call prime, decent grade A quality space. And there has been a flight to quality. So people, are prepared to pay decent quality rents for best in class space. And we are going to have a shortage soon.
Yeah, okay, thank you. Another question that's just come up on the Q&A, and actually is one that I was about to ask Stephen in any case, because it was also submitted by somebody else in advance. How have valuations been affected by the pandemic? So what generally, I know you talked about development land, but general valuations, how are you coping with the challenges that are presented by the pandemic when you're carrying out valuations?
Thank you, Ben. Valuations largely rely on pieces of market evidence that a valuer is able to lay their hands on. And this piece of market evidence needs to be as relevant as possible. And therefore, with the current variables that inform valuation, by this I mean land transactions, rent levels, yield curves, and those sort of things, because they are now reflecting that level of uncertainty. We are seeing generally value reduction other than in logistics, which I would consider more stable. The prime yields pre-COVID were in the region of 8.5. We are seeing a push towards 8.75, towards 9, and in some instances 10. And therefore, those yields are definitely, forcing and pushing values downwards. And so it's everywhere. If you analyze the transactions that have happened post-COVID, across sectors, really, we are seeing a pointer towards reduction in values. And generally speaking, values have gone down, but not in the same amount. Some are more affected than others. And like I said earlier, hospitality is the worst hit. Retail, upmarket residential, upmarket office, least affected. The middle class residential. And logistics being flat or significantly moving up.
Okay, so we've seen it. We've seen a slight downward trend in values, softening of yields. Anthony, do you want to add to that? What's your experience of yield movements in the market?
Yeah, I think Stephen's bang on, and as ever, I'm going to come from the agent's perspective, which ultimately valuations I think tend to lag what's happening in the real market, and I think we've definitely seen a decrease. Obviously, we've talked about rents, but in land values, Charles put up a great slide there showing just an average of basically a 30% reduction in prime development land across the city, and that's naturally flowing through to capital values as well. And we have seen some live evidence of yield shift from what's traditionally been 8.5%, 9% in the market to what I think is double-digit yield. And what that has basically allowed is it's allowed the global investor, the international investor, to look at the region and think, yeah, that's starting to look like reasonable value if I compare it to what our international classes are like. In addition to which the local investor, as against what they'll get from a government bond or alternative assets here in Kenya as well. So I think with that correction and an adjustment in price, I think it opens up for a really exciting period of capital markets activity and general exciting times, backed up by obviously quite a lot of excitement obviously going on in the occupier market. So yeah, I think positive days ahead.
Excellent. Thank you very much for that. So I had a question here, and this is the way this is worded. It's clearly an internal question, so please forgive me. The research team did a great job on this market update, clearly highlighting the effects of the COVID-19 on the property market. It would be amazing if they did a small section on the coastal property market too. Eager to know what's happening in Kisumu and the Mombasa markets. And actually, I also have at the same time a Q&A question. Great presentation. Does the positive outlook for commercial, retail, residential sectors apply for the coastal market too, or the view is largely based on trends in the capital city? And I have to say, we are often guilty of focusing on Nairobi because not only is it the capital city, but it's also the regional hub as well. And so it's disproportionately bigger in terms of its investment market and real estate market generally. But I think, Charles, if you could have a go at that, what can we expect from the secondary cities in Kenya, Mombasa, Kisumu, and so on and so forth? And are we anticipating any research relating to those areas anytime soon?
Definitely, some research would come out with respect to those particular areas, because each area has its own microeconomic factors that affect the real estate market in those areas. You find that, for example, at the coast, that was largely reliant on the tourism sector and has been heavily impacted by the pandemic. You found that there's a more of a decline in property values than it is at the capital. As well as various infrastructure projects, those continue to affect property values, not only at the coast, but in Kisumu and the other urban centers. You find that at the coast, the expansion of the ports, the bypasses, these are all geared up to grow the real estate sector. That said, look out for a sector by sector view on particular urban areas, other capital cities in Kenya. So,
okay, thank you. Question from the Q&A here. Will there, and this I think relates to some of the stuff that Anthony was talking about earlier, so perhaps you could have a go at this one, Anthony. Will there be opportunities for foreign engineering and construction companies to partner with Kenyan firms to meet the future demand for new buildings, especially the structurally complex grade A and green buildings? I think that probably applies to architects as well. I've got my own opinion on that, but Anthony, do you want to have a go at that? Do you see an influx of these specialists to deal with this, or do you think there'll just be a natural skills upgrade from our existing organizations?
I think there has to be a bit of both. And I think local organizations can certainly learn off the international professionals at the same time. I think we've certainly seen a growing trend, I think, in the last 18 months, 2 years, of local developers starting to look overseas to international architects and other professionals in order to start to raise the bar in terms of the quality of the product that they are producing. And I think we've seen 1 or 2 great quality buildings as a result. So I think the answer is yes, of course. local professionals are clearly obviously dominant in their own market, but they have to be open to change and acceptance of global professionals coming in with increased professionalism. So I think there's opportunity for both, and I do see both moving forward.
Okay, so I also have a question on the Q&A and pre-question. I'd like to know healthcare, tertiary and quaternary care opportunities in Nairobi and Kenya. Why have we not witnessed quality healthcare facilities being set up in Nairobi, Kenya in the last decade? And what are the obstacles, regulatory, government support, finance, affordability, lack of availability of quality healthcare professionals, etc.? And also on the Q&A, how do we go about? Oh yeah, no, that's more about. Okay, so Charles, can you have a go at that one? Why are we not seeing more healthcare, or indeed are we, and we're not simply aware of it yet because it hasn't come to fruition?
Yes, we are seeing quite a bit of healthcare facilities coming up, but the key player in this sector remains the central government. You find that they are undertaking various expansions of various healthcare institutions. You find that there's the kidney care and cancer center next to the Kenyatta National Hospital. But the key issue here is the affordability of those healthcare services. You find that there's as much as we want, the developers would want to cater to this niche, you find that the general most people just can't afford the quality healthcare. So you find that health tourism is still a thing where you find that most people are going to India for their specialist services. So the key thing is affordability of those healthcare facilities. That said, we are also seeing local investors investing in it. AAR just opened the healthcare facility along Kiambu Road. So there's still opportunity, but the key thing is the key challenge remains affordability. By the masses.
Okay,
yeah.
So I think we're out of time there. We've got one more Q&A question, which is, can we expect to see a lot more capital markets activity in Nairobi going forward? Global developers, private equity, purchasing large property assets like Grade A office buildings? Yes, we can. That's as much as I can add to that right now. In the chat, you will see, no, you can't see this, only I can. So you can sign up to our mailing list to get regular updates about our properties and reports at knightfrank.co.ke/mailing list. So that I think we could probably put on the Q&A. Please do get in touch with us, as I say, if you want to download the report. But that just brings me to say, our aim this morning was to share insights that would enable the identification of opportunities for you to maximize value in every aspect of your property dealings. So we're very keen for the opportunity to add value. And so should any of you wish to discuss your property requirements with a member of our team, you've seen a selection of them here, or require further information, we would be more than delighted to provide it. So as I said, for those of you who wish to download a copy of the Kenya Market Update, we will forward you a link for how to do that. And it's also available on our website. So thank you once again for joining us. I hope you enjoyed that and do enjoy the rest of your day. Thank you very much. Stay safe, keep well, and we look forward to hearing from you soon. Bye-bye.